Hey, hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you folks what you need to know before you roll, and that's going to be talking about economic data, how that impacts the markets with a little market analysis, maybe even throw in a little geopolitical fodder to round off that analysis, and then finally talk about some option strategies we could implement into a portfolio based on those assumptions we come up with in this analysis. All right, so without further ado, today's the day we were looking for the GDP numbers. We started getting ours in yesterday, right? We talked about those data points here in the United States. Our advanced GDP came in negative, not leading us to believe that much is going to happen here overseas because we've already seen that they've started to slow down. Now, one thing I've noticed with this negative GDP number, 2 quarters in a row signals in the past a recession. Now, all of a sudden, for some reason, everybody's changing the definition of that. It's great. Now we're not in a recession because we've had 2 days or 2 quarters in a row in negative numbers. Not maybe fitting that bill these days, they say. Well, it's really they're talking their position, folks. They don't want to say they're in a recession, of course, because we just came out of a trajectory of higher growth, all right? And now they're starting to flip that switch. So here in the United States, here today, we got GDP numbers across the pond, all of them coming out a little bit higher than expected. Now, something to note with this GDP number is its gross domestic product. It is the statistical anomaly here is that higher prices is going to drive that number a little bit as well. So while we're seeing unemployment rising in like Germany and other areas of Europe, we're seeing the GDP numbers rise as well. Personal spending, that's rising more so than what we're seeing here in the United States, our personal income rising. So all of these things that we're seeing, spending is happening. And that's because we're kind of forced. We're having to buy these higher prices. That's making GDP look much better than what it should. On the flip side of it, we're seeing employment start to rise overseas. That's slowing the economy, or because of the slowing economies. And then here, we get the CPI, Consumer Price Index, that jacked up in Europe to 8.9, expected to be 8.7. Core CPI in Europe, 4%. So all of these numbers really coming out much higher than expected there. And then here in the United States, we got our own core personal consumption expenditures. That rose to 0.6. And generally speaking, these numbers coming in better would signal health in the economy, but they're just a little bit flipped. When we're seeing unemployment start to happen, companies are laying off. We're seeing Walmart call it that they're missing on earnings. These are all signals of a recession. And in the meantime, we've got consumers like you and I going out there and spending. Well, that's good to help the economy. The bad thing is our income hasn't increased enough to keep up with the spending. So folks, we're seeing savings actually dip right now. The whole thing with the government and Fed funds raising those interest rates is to keep us to try and create savers out of you and I. But right now, with the prices driving higher, we have to still sustain a livelihood. We have to buy gas. We have to buy food. And despite the fact that those numbers are going higher, we're having to spend money for those just to get through this. And that's driving our savings rates down. Not a good thing. A couple of real curveballs being thrown at this economy right now. And Wikipedia coming out and saying that this whole definition is wrong of a recession. And now I guess you can't change it back. So it's kind of weird. All of a sudden, everything's starting to change to fit somebody's narrative, if you will. So with that said, I was going to throw up a couple of opportunities in here, but we'll do that towards the end. All right. Overnight, we've got pretty much flat markets in the equities. I'm going to throw through these a little bit different today. I would expect a little bit of weakness off of these numbers today in the morning, but as it's a rush to the Hamptons, although I don't know if it's raining out there, folks could be leaving early. As you can hear at my place, it is pouring down rain. It's monsoon season, so we're getting some big rain showers these days. All right, so E-mini S&P's strong day yesterday, all the way into the close. Dow Jones Industrial Average very similar, but I think we're going to get a bit of a topping pattern going on as the markets are going to start realizing that despite the fact that Wikipedia changed the definition of what a recession is, 2 quarters in a row of negative growth, may not change the overall feeling with the Main Street investors. Yesterday, we threw this line in here as a line in the sand for something to break through. Could be seeing a little bit of resistance there. Look at that. We tagged it twice off of this last high here. So markets trying to break through there, but the bears are trying to continue with this lower low type of pattern here. So that's going to come into effect. We've already seen it a couple of times. Be interesting to see whether or not we settle above that. I would say that's very bullish. If we can get a settlement above that, if we settle below that, it's going to look like a bit of a retracement, probably down in NASDAQ to 12,500. All right. That's going to be where that Fibonacci 100 Fibonacci. This is the extension off of the, I believe, the pandemic. So the 2016 low to the pandemic high, and then measured moves off of that, because that pandemic move, when we were going into that pandemic, the economy was actually trudging along really nicely. It wasn't overheating. It wasn't too cool. We weren't worrying about it slowing down. It was just a nice trajectory. And that's why I want to pick that point in time there that everything changed and do measured moves off of that, because coming back down to these levels gives us a pretty good sense of where we were in relation to history there. Really, the major thing that I'm concerned about is obviously crude oil. I do not want to see this market go back into the 100s. I would rather see this go back down into the 80s, in 70s for that matter. But the only way to get this to happen is to increase supply, folks. And with this current administration, they are not too keen on increasing productivity here in the United States. They are a little bit more interested in trying to buy our oil from somewhere else. Now, gold, last few days with the inflationary worries finally starting to get some moves here. You know, the strength in the dollar has been holding gold back a little bit, but I think that this sell-off to the downside is way overdone. I've talked about this, the tweezer bottoms here. We've gotten a nice little bounce off of that move. Now finding a little bit of resistance right there at around 1775-ish area. I think that this market is going to at least migrate back to 1800. It should probably go and test the value area high here, I think, in the next month or so, just because of all of the unknowns going on in the world right now. The equities, I think this equity sell-off is lasting a little bit longer than expected, and folks are going to want to have that money that we've talked about is just sitting idle in cash to work. And the best way to put that to work in uncertain times is in gold. I think we should see some upward moves here in gold pretty shortly here. I talked about, what was it? Bitcoin. I wanted to take a look at, you know, it's following lockstep with gold futures losing a little bit of momentum here around that 50-day simple moving average. I was thinking that the newer investor was going to start looking to park some money here at these levels, but it just isn't getting any type of love right now. It's kind of like along the lines with gold there, that we aren't really seeing anything come out of that. Bonds continue to climb higher. This is signaling major recession, right? Not major, I shouldn't say major, but it is signaling recession. It's saying that the Fed is raising interest rates too fast, too quickly, and they are going to need to lower the, excuse me, sorry about that, folks, need to lower those overall. All right, I'm going to end up having a sneezing fit, I can tell right now. So I'm going to let you guys go. Hope you guys all have a great weekend. Make sure you guys check out the webinars that we're doing. Don't forget to subscribe. If you aren't subscribing, you're going to miss out on a lot of content. We're popping in here unannounced on all kinds of things. We're going to be doing interviews and all kinds of new content for you guys. So make sure you subscribe with the little bell, because those interviews and everything else, we're going to be popping in here unannounced. And that's the only way to be able to catch that content live. All right. So have a great weekend. And if you can't take that, take it easy.